Hakes. I'm joined by a local CPA here in San Diego, Kali Chaudhuri. Kali, thanks for joining us.
Pleasure to be here. Thanks for having me.
We've got a fun video today. We're going to talk about some big tax changes that are on the horizon. For people that are familiar or unfamiliar with what's coming up at the end of next year, we had a big tax bill that was passed in 2017, the Tax Cuts and Jobs Act. That was one of the most substantial pieces of tax legislation that's been passed in quite a few years. It made changes to the personal level, to the corporate level. It changed just about everything as far as taxes go. And that's set to expire at the end of 2025. It goes completely away and we go back to the old system. So we're here today to talk a little bit about some of those changes and what's coming up. So why don't you kick us off and talk to us a little bit about, what's happening at the end of 2025?
I'd love to. Yeah, thanks. That was a great summary. Definitely the Tax Cuts and Jobs Act that was passed is set to expire at the end of 2025. So we're in 2024 now, so I think it's a great time to start planning for any upcoming changes so it doesn't spring up on you, at the last minute. So it's a great time to start talking about this stuff. There's lots of different changes. A lot of them are very nuanced, but I think we can kind of break it down into certain areas that affect, most of the folks that will be watching this video. Individual changes, number one, also like pass-through entities, LLCs, S-Corps, and the like, those kind of changes that would be happening. Some people have C-Corps, so there's some changes around that as well. And then also around estate planning, so we can kind of get into that really quick as well.
Absolutely. So talk to us. So let's kick it off with on the personal side. There were some big changes. I think people are familiar with some changes to SALT tax deductions and standard deductions and all sorts of things that changed. Why don't you walk us through some of the changes to on the personal side of taxes? What changed in 2017 and where were you going back to?
Yeah, absolutely. Well, first of all, the tax rates, the rate tables for individuals is definitely going to be, changing or reverting back to the pre-2017 levels. So for most people, that will be an increase in those tax rates. It just depends, but for the most part, it would be. For example, a married couple with a taxable income of about $250,000, on average might see their tax rate increase from 24% back up to 33%. So that's like an example. Another thing is the standard deduction was something that was really increased during the Tax Cuts and Jobs Act. So that is going to be reverting back. So the standard deduction is going to be cut roughly in half, which is a big deal for many people, which will kind of push a lot of people back toward itemizing deductions. Itemized deductions include taxes, interest, and charitable contributions. So those things become a lot more important after the expiration of these tax cuts. So in planning, those are the types of things that might get your deduction levels higher again. So you want to start thinking about, if you're going to buy a home, the interest on your mortgage is going to have a much bigger impact. The property taxes that you pay are going to have a much bigger impact, and anything that you give to charity is also going to have a much bigger impact on your ability to deduct beyond the standard deduction. So,
what are your thoughts on one of the arguments when they passed the law was that a lot of these changes were going to simplify the tax code for average people. Increasing the standard deduction obviously increases the number of people that can just go with the standard deduction. Do you think that this will complicate taxes a bit as we go back towards the old system?
I think for many people it may, in the sense that there's a little bit more work that their tax preparers are going to have to do to get get all the pieces to their returns to maximize their tax savings. But especially for a lot of people on the coasts that have high levels of property taxes and state and local taxes, it should help them. Where the itemized deduction has a bigger impact for them. So there might be a little bit of extra legwork kind of to get the taxes prepared or optimized, but the end result might be better, for those states that don't have high, state income taxes, or they don't own a home, then I think that this might be, a net negative and, for them. But, there's other provisions in the code that can help offset, in the deductions and credits and the more nuanced deductions and credits. So,
no, absolutely.
yeah,
and I think here in California, you mentioned on the coasts, we have very high taxes. We have high property taxes. I think that the $10,000 SALT cap was a big deal when it was passed. That caused a lot of issues here in the state of California. You mentioned that the increase in taxes for a married couple making $250,000, that is substantial. On the flip side, they do get some SALT relief, which, there might be some balance to that.
Right.
But it's definitely some change that'll be coming down the pipeline.
Right.
Turning from the personal side, there's also some changes on the business side. We'll stick to, smaller entities. There's some changes for larger corporations as well, but walk us through some of the changes on the corporate side to taxes.
Yeah, absolutely. So one big one is that for pass-through entities like LLCs and S-corps that a lot of entrepreneurs have, there is a deduction called Qualified Business Income Deduction, or QBI, which was a 20% tax deduction on business net income. So that'll be phasing out completely. So that'll have a big impact for a lot of people that have pass-through entities like LLCs and S-corps. For C corps, there's a corporate tax rate right now for a federal rate of 21%. That will be also reverting back to a higher 35%. So that'll have quite an impact. And then again, there's another tax provision that was put in called the pass-through entity tax, which is also something that was put in place to help offset the SALT cap deduction. So although they're not equal to each other, the SALT cap was on the personal side, the PTE or pass-through entity tax was on the business side. But that one would also be going away, which allows you to deduct a certain portion of your business net income by paying in funds into the state and getting a refund from it later, and then taking a credit on your personal return. So a little complicated one, but that one it will also be going away.
Planning around these tax changes, we have rates going up and down in a variety of different ways. What are some things that people should be thoughtful about when planning ahead for these changes? What could they be doing to potentially maximize or minimize their taxes, maximize their benefit?
Yeah, I think from a business standpoint, if you have QBI going away and you have PTE going away as well, these are big deductions that offset your business net income. So if there's certain types of deductions that you're taking, like depreciation, bonus depreciation, like accelerated depreciation, or a big purchase that you're thinking of making, and you already are optimized in the current year based on the deductions available to you, some of them will carry over into the next year. But to the extent possible, you could also do some planning around deferring some purchases or things like that to kind of take advantage of, finding other offsetting deductions in those future years that you would have otherwise gotten in the current years. So that's one thing that you can do. As far as making investments and things like that are deductible, same thing. You can basically, maybe if you're thinking of holding off and putting it off toward a future year where you can get those extra deductions, that might help offset some of these like these items like QBI and PTE that are going away.
It sounds like, obviously there's a lot of complexity here, but heading into next year, I think clients, you mentioned business owners, but even on the personal side, should definitely be having conversations with their CPA about their situation to see if there's any adjustments that they can make. Like you mentioned, with a big change like this happening, deferring things to 1 year versus the next could make a substantial benefit.
Yeah, it definitely can. There's also, carryovers and the like that will also be present, but, a lot of these things require cash investments. So, sometimes waiting has other benefits that are economic versus tax as well. So I think that having those conversations with your CPA is really, really important.
So turning to the last major change, and you hit on it a little bit at the beginning, but we have some very substantial changes to the estate tax limits, and specifically the personal exemption from estate tax. A lot of our clients are familiar with this. We've talked about it in the past, but why don't you walk us through what's happening on the estate tax side? Yeah,
absolutely. So the lifetime exemption on the estate tax side is currently $13,610,000 approximately per person. And anything after that you give, to somebody else is going to be taxed at 40% essentially. So that's, it's a big limit. So that limit at the end of 2025 is actually going to be cut quite a bit down to approximately 5 to 7 million. So this is something that you really need to think about. If you're going to do some giving, it's important to do it now, because if you go past that time, you won't be able to do it without incurring quite a bit of tax. There are some things you can do. So like number one, do it now. Like, if you're going to give something, give it quickly within 2024 or 2025. And then beyond that, things that you can think about are like, okay, well, are you taking advantage of the annual gift exclusion? So that's currently $18,000 a year per person that you can give without reporting it or filing a gift tax return. So that's something you can do consistently on an annual basis. The other thing that you can do is use things like grant to retained annuity trusts that can move some of that gifting off into a trust that gets excluded from the exemption calculations. The other thing is you can use something like life insurance too. So if you use life insurance and you moved funds into an irrevocable life insurance trust or things like that, those are the types of things that can move parts of your assets away from this calculation of the personal gifting exclusion. So those are things you can think about doing afterward, but definitely take advantage of 2024 and 2025 to maximize your gifting so that you can stay under the exclusion.
It sounds like there's some pretty significant changes on the estate side. I think people have, a year and a half to start thinking about these things. Obviously, they need to talk to their CPA. They need to talk to their advisor. They need to talk to their trust attorney. As far as everything that we covered, if clients have questions either on their personal side, on their business side, and they want to talk about doing some planning, how should clients reach out to you if they have questions and they need some help?
Yeah, absolutely. Again, my name's Kali Chaudhuri. My firm's name is Hara Chaudhuri CPAs, and we are based in San Diego, California. You can call us, email us, and we'll provide that information in this video. And we'll definitely love to take your calls and answer any questions that you have.
Thanks so much for joining us, Kali.
Thank you very much for having me.